I'm glad we're getting to the core issues right up front. So, I don't have a newspaper in front of me. I should have brought one. But because one of the things, in fact, I'll do it maybe in my next presentation sometime, is this is my plan for my next presentation to answer that question. I want to take the Economic Times or Wall Street Journal or whatever, and I want to create a dartboard out of all the stock quotes page. Create a dartboard. Maybe I'll actually create a real dartboard. Have some unpaid intern do that. And then what I want to do, I want to take a dart and throw it at that dartboard. And whatever stock it lands on, I want to take that stock and just give you the statistics of that stock. So let's say, let's take a company in the US like General Motors. Huge company, car company, I don't know, close to 200 billion in sales, 150 billion. No, I think 200 billion in sales. So if you look at the 52-week range on General Motors, and you can do the same thing with Infosys, you can do it with Tata Motors, you can do it with any company. You can just throw a dart basically. And what you will find is that in 52 weeks, which is in 1 year, the time it will take the Earth to go around once, General Motors was at one time being valued at $18 a share. And in fact, just yesterday, it hit a 52-week high. It's over $36 a share. So in 1 year, on this one stock, you have basically pretty much 50% movement. I mean, it would, you basically double the market cap from a year ago or whatever. So, and the business, the underlying business, has not changed that much. Okay, if I look at Infosys, I don't know, you guys, what is the price of Infosys right now?
2,800.
I'm sorry?
2,800.
2,800 rupees? And what is the 52-week low on it?
Around 2,200.
Okay, and what's the 52-week high?
I guess it's the high. I'm not wrong.
So it's 22 to 2,800.
Yeah.
Right? Okay, so you have a range of 30% or so. Okay? The reason you have these ranges, now if you look at any other asset class, so let's say I have a 3-year-old Maruti car, okay? The price I could get for that car a year ago, a 3-year-old Maruti, and the price I can get today, again, the same 3-year-old Maruti, maybe within 5 or 10% of each other. Okay? Even for the most part, real estate, movement is low. Stock markets are different creatures. And the reason they're different creatures is because they are auction-driven markets. So you don't, in the case of a car, you have an intelligent buyer facing an intelligent seller. And between the intelligent buyer and intelligent seller, they will arrive at the price of a car. That makes sense. And if they don't arrive at an intelligent price, there will be no transaction. So both sides have to agree. In the case of the stock market, you have basically faceless buyers and faceless sellers. And you have an auction-driven mechanism for setting pricing. And auction-driven mechanisms, by their very nature, are set up to create distortions. And Warren Buffett has benefited big time from those distortions. So if there was no stock market, Buffett could not have done what he did. If, let's say, Warren Buffett were restricted from 1950 till today to only buy private companies from intelligent sellers, nowhere anywhere close to what the record is today. It is because we have this mechanism of this auction-driven market that we have this distortion. So if I went to buy GM a year back and I went to them today, the price will not change 100%. Okay, it will change 5%. Even if in the case of Infosys, you go to buy the whole company and they give you a price today, and you go to them 6 months from now, the price will not change that much. So bottom line is that it is the auction-driven nature of these markets that causes these wide distortions. And the second is that especially when there is extreme fear or extreme greed, you will get attenuation of that distortion. So Infosys is something, for example, which is a blue chip company. But what if I pick something that is an obscure company? Let's say I pick some, regional jute producer in Calcutta, something 100 crore market cap type thing. It will have a wider distortion. Okay, but that same company, if you go to do a private transaction to buy the company, you're not going to have those distortions. So the stock market is set up for cloners like me to have a field day. So, the same thing you see in the public markets, Facebook comes public, everyone's excited about Facebook, the stock price goes up like crazy, and then a few months later, no one's interested. And that goes on all the time. So markets are constantly overshooting, sometimes where they significantly overvalue the companies, or they're significantly undershooting, where they're significantly undervalued. And because of the significant over and undershooting, you can sit there. So bottom line is that if you have that much of a swing, 50%, 100% type swing in a year, it means that there are enough companies out there that are not correctly priced at any given time. They are either underpriced or overpriced. And especially if you overlay on top of that distress, some kind of temporary situation which affects that business, that will cause even more attenuation of the pricing. Because the other thing that's happening in public markets is that any company typically in about 2 years, sometimes in 1 year, sometimes 6 months, the entire turnover shareholder base changes. So people aren't even holding the stocks that long. So all of these things basically mean that some yo-yo like me can sit there, spend most of my time talking to you guys or hanging out with Dakshina scholars, and every once in a while I see distortions of an extreme nature. And when I see distortions of an extreme nature, then I act decisively. And I don't even need to be right all the time. I can be, in fact, John Templeton, who was a great investor, said that there is no investor who's right more than 2 out of 3 times. So you can be wrong plenty of times, and you can still do fine. So, I think that these distortions take place all the time. I think if you understand the business really well, so the first most important thing is circle of competence. Stick within things that you understand really well. If you understand things really well, you know what they're worth. And when the world is valuing it much below what it should be worth at, that's when you act to buy. And when the world is valuing it significantly above what it's worth at, then you sell it and you're done. Nothing else to do. So maybe you have 2 or 3 buys a year, maybe 2 or 3 sells a year, and we move on from there. Next question.